Howdy and welcome back to the podcast. Today we have Mr. Justin with private equity. We're going to learn all things about private equity. The first thing that we're going to do, though, is we're going to try some chips. So I heard about these chips yesterday, and then Tyus is over there in the back looking to see what kind of chips these are, or our reaction to these chips. So open a bag and have a taste. They are pussy chips.
Oh.
Pussy flavored chips.
Okay.
So here we go. I am so interested.
Now to get out here, you're having one.
Yeah, everyone should have one. This would be fun. Great packaging. There's only like 5 chips in here.
Does it have like a nationality or like?
That's a good question. We should ask the owner. All right.
Maybe that's what we should be guessing is, whose.
Whose?
Yeah.
There you go. And then
Cheers.
cheers. Boom. That's very odd.
Yep. I'm going to say not accurate.
Not accurate. Not accurate at all. It's kind of, I don't know. The flavor has kind of turned me off a little bit. I'm not going to lie.
Great marketing.
Great marketing.
Yep.
I think that's the whole point, right? It's to capture your eye. What do you think, Tyus?
Not correct. Exactly. It's just simply not correct.
Yeah. Well, that was fun. We
It
tried
wasn't
it.
bad. I liked it.
Really? You can have them.
It's perfect.
There are
Bring this home to my wife and be like, this is what we did today on the podcast.
We ate pussy chips. I don't know.
Yeah.
That's kind of interesting. I don't think I would ever do that again.
Nope.
Well, thanks for trying something new with me.
Hey, my pleasure. I'm here for it.
Cool. So this is not your first time in the studio, so it's happy to have you back. First time on this show, and I want to learn about all things private equity. So, like, to kind of give people a background, who are you? How'd you get into PE? What is private equity? Is it really as scary as everybody thinks? Are you BlackRock? What are you doing?
Yeah, I guess on that topic, there's layers to this private equity thing. It's like a fancy name. It's kind of like when you start your first fund. It's a fancy name for just an LLC. It's just an entity that's set up a certain way to do a certain thing, right? But we put all these fancy buzzwords on things to make it sound all complicated, feels out of reach. Kind of like when I was getting into the fund world, I just thought that I couldn't because I thought you had to have an MBA, you had to go intern on Wall Street, like all these limiting beliefs, and anybody can do it.
So I can just open today. I open an LLC, and then I just have a group of investors, accredited investors, and then we get together and buy things.
Yeah, you would have to set up that entity to be structured to accept limited partner capital. That would be what that's called, right? So it's just a certain type of document. We'll call it a private placement memorandum, known as a PPM in the industry, and that's what an investor signs on the way into you accepting their capital. So it's just something an attorney's got to set up for you, and then you can raise money, and then you can go buy businesses, you can buy real estate, you can buy whatever, and depending on the industry, they call it different things. In real estate, they'll be like, it's a syndication. If we're buying businesses, it's private equity, but it's really all the same thing for just taking other people's money and using that leverage to go acquire assets.
That seems pretty simple.
Try to make it simple.
But from the outside world, not so simple. Why? Like, outside of, okay, I need an MBA or these like limiting belief ideas, it still does seem like you need to be fairly advanced in some financial knowledge.
Yeah, I'd agree with that. I think you learn from doing business. How are you going to buy businesses and be able to evaluate them if you don't know that niche? So that's how it started for me, was direct sales, building a company. Did that for over a decade with my dad, and then we sold that to a private equity firm. So that was my first experience with that process. So being on the selling side of it, I think kind of helps when you go into the acquisition side.
Very cool. So what was the first business you guys sold?
It's called Heartland Home Foods.
And what did it do?
Organic food delivery. So it was a lot of bodybuilders, trainers, dietitians, chiropractors. Those were all of our partners. So we would go to farms and get the highest quality stuff, but it was cut spec to pack. So, if you're a nutrition person, which I know you are, and you want your chicken cut 4 ounce, 6 ounce, 5 ounce, for your meal prep, we can have it all individually cut, vacuum sealed, and then shipped to your house. So it was like meal prep done for you in a way, but like really high quality, free range, pasture raised stuff.
And then you guys sold in the middle of COVID.
Yeah.
What was the intention? Like, why sell?
We never intended on selling the business. It was going to be a family business we were going to keep forever. But the pandemic put everyone in the market for the first time for food delivery, whether they were just scared to go to the grocery store or they tried it for the first time. It was also the same era of Blue Apron, HelloFresh, Amazon, starting to do Instacart, like all of this delivery stuff kind of hit the market at the same time. We were a decade early. So it's a very interesting lesson because when competitors come into the space like that have big private equity backing them, a lot of venture money, you're like, oh, we're going to get cannibalized. Like we're going to go out of business. And it's the exact opposite because they spend so much money on marketing. It actually helps you become part of that solution. So some people are actually going to find you on Google now because they're even looking for it. So they created the market. Everybody was sitting at home. We essentially cut our marketing spend to zero and doubled the size of the company overnight.
Damn.
And that's when private equity firms started saying, hey, we want to buy up all these little food services, roll them up. And that's a thing private equity does. It's called a roll up. And, when they want to buy you in a bubble, you gotta pivot and sometimes just make a decision. So that's what we did. We decided to sell it.
And what was if looking back at young Justin in the middle of selling this thing, what did young Justin goof on and what did he do well?
On the way to selling it? Or
yeah.
I think.
Or even in the selling process.
Yeah, I think the biggest thing I learned in that process is like what makes a business multiple. Like why do some businesses sell for one-time sales? Why are some selling for 50 or whatever, and everywhere in between? And the more you invest into your business in terms of systems, processes that can scale to different levels, the more valuable your company is. So it's not just a sales equation; it's also an infrastructure equation. It's all these things that I didn't really realize. That would add up to the multiple you actually get when you go to sell your business. So that's what I would have done differently over the years is invest more in systems, processes, technology, things like that. So that we would have had a bigger multiple on the exit.
It seems hard to value a process a little bit or it does not generate me revenue, but it's setting me up to generate revenue. So then how do you evaluate the process of a business?
Well, let's take something really simple like your accounting. If you're using QuickBooks, very different than bringing in enterprise software like NetSuite, right? That can scale you to hundreds of millions, whereas these other, mom and pop small business stuff doesn't. Very expensive to implement a software like that. Whereas if, you're going to an enterprise level, you might need Salesforce, which is going to be a lot more expensive to the business than if we're just using a go high level system. So that's what these private equity companies are going to look at. It's like, hey, when we buy you, do we have to implement all this stuff or is it already ready to scale?
Got it. Have you guys already put in all the cash that would initially take to have Salesforce or NetSuite kind of involved?
Right. Because the break points of a business, 0 to $1 million is very different than $1 million to 5, 5 to 10, 10 to 25, all the way up to, $1 billion.
How well were you guys doing at that point?
We were crushing it. I mean, we were doing over 10 million in sales annually. It's a very difficult business. That's the number one thing I learned is I just would never want to be in a super logistic heavy business like that. I don't have a Jeff Bezos brain, So for me, that's what kind of put me into the private equity space and real estate and hedge funds is it's just like you could build, 10, 20, $30 million business relatively quickly without infrastructure, without staff, So it was kind of like, how do we put in the same amount of effort and get 10 times the results with much better margins? A better recurring revenue model. I mean, we're talking in the food business, you have thin margins to begin with. Then you've got logistic delivery costs, gas, tolls, employees, cold storage, the utility bills in the six figures. Like you could be doing $10, $20 million in revenue every year and barely making any money. So I don't think there's a right or wrong way to build a business. There's plenty of businesses that are valued in the billions that don't even make money. So you just...
How? That makes no sense to me. I know that that's a thing, but why?
Users, adoption. The greatest businesses in the world are masters of low ticket. So think of, Apple cloud storage every month hitting you for $9.99 or like whatever your level is. And everybody in America has to pay it. They don't even think about it. A Netflix, right? $10 a month, $20 a month. Everyone pays it. So if you have a product or a service that has mass adoption, it has the potential to sell advertising revenue or all these different ways to monetize the business and the value is in the user at that point. So a lot of different ways to do it. I'm more on I'd rather be smaller with big margins and not run a massive business, but that's just my identity.
So then what kind of businesses are you buying?
Right now we're buying boring stuff, right? Let's say e-com business. Like we just bought one that's it's a certain type of, I don't even know what they do, but it's like baby oils, but they've got great margins, like 50%. And that's just a simple game of scaling advertising and building profit. And then, our debt fund is what buys the businesses. We're paying those investors 16%, 12% monthly cash flow. At the end of 5 years, we give them their principal back with a 24% kicker. So anything above that 16% internal rate of return, we're keeping. So if we can take that capital and go buy a business that spits off 40% free cash flow, you're using other people's money to essentially keep a spread.
How do you gain the trust of individuals to give you their money to so that you can make money?
That's the hardest thing. That's the hardest thing in this game. And that's why raising capital to me is the hardest sale there is. You have to literally have someone else believe that their money is safer and you're going to grow. Yeah. Yeah. And money's very emotional, right?
Yeah.
So track record really matters. That's why early on, everything's about your partners. Scott Boroff, who's the founder of Pitch Equity, one of them, there's two, but he did $1 billion on Wall Street as an investment banker before even going on the private side. Now he's got 22 exits. He's taken multiple companies public, right? That's someone I want to attach myself to and say, hey, like we can go a lot farther together than if I try to just bootstrap this thing myself.
Is that someone that you've like identified that this is someone I want to work with?
Absolutely.
And then have you?
Yeah. Yeah. So we're in Pitch Equity Fund together. Okay. And he also put me on his public company, Safe Space Global. So I'm the capital advisory chair there and I run the investor relations. So we got a public company that we're running and we've got the private funds as well.
What would you rather stay in, public or private?
The public space is crazy.
I would imagine.
It's crazy. Yeah. I've only raised capital one time for a public company, which is very interesting because you can raise private capital into a public company.
How?
Right. So you have something called a volume weighted average price, right? So for 30 days, whatever that price is the private price for the next 30 days. So we needed to raise $6 million just to put on the balance sheet because we're checking boxes to uplist onto the New York Stock Exchange. So when you're on the over-the-counter pink sheet markets, it's a very different game. Like RIAs aren't buying your stock or recommending it, broker-dealers, institutions. So one of the requirements to uplist is you have to have a couple years of burn rate sitting on the balance sheet. Scott had funded the whole startup from the beginning. Company has no debt. We didn't really need any money, right? But we need to check that box. So when we went out to our friends and family and said, hey, we're doing a friends and family round at 10 cents because that's where penny stock.
Yeah.
This is back in January. Quickly, when we announced that raise, the public market started buying it and the stock went up to 40 cents. Right. So now I'm going out to friends and family saying, hey, $100,000 or more, accredited investors only, you can buy it at 10 cents. The public share is at 40 cents. So imagine day one, you put your $100,000 in, it's worth 400 on day one. It's not a very hard raise.
Yeah.
Right. Especially because on the private side, there's no liquidity, right? You don't know how long your money's going to be tied up. There's a lot of other factors. Whereas if you put it into a public company, there's a lockup period, but you'll have liquidity at some point.
Yeah.
Very different.
Like within 90 days.
Yeah,
or whatever.
6 months, like whatever the
yeah.
hold period is.
Damn.
Yeah.
That's wild. What a weird way to move money.
Yeah. We cut the raise off at 10 million. There was still a ton of people who wanted to throw capital in, but you don't want to dilute the shares, more than you have to. So we took a little more in than we needed, but also strategically, if we want to make an acquisition and buy something that vertically or horizontally integrates with the company, that's what we'll probably use the extra capital for.
So I have some questions that I'm going to kind of pivot off of because I'm personally interested. So
Yep.
if I am looking to raise in a safe, so let's say I'm doing my first round of raising and a safe is a simple agreement for equity, how does somebody decide what their cap rate is in order to not dilute themselves within by their second or third round?
Wow, that's a tough one. Man, I don't know. I feel like you'd have to dive into the particulars of it. And this is also why partners are really important. the underwriting side of this, the deep details on the finance stuff is not my specialty.
Your specialty is getting the capital.
Yeah.
Getting the people.
The relationship side, nurturing, because there's a big service aspect when you raise capital. You know, like limited partners, they forget that they're limited partners. They think because they put their money in that they've got an active voice, you know. Yeah. So those relationships and personalities have to be managed.
How do you manage? That's an interesting personality to manage.
Yeah, I mean, it's just something I've just been. I think, you know, like sometimes you don't know what you're preparing for. In the first half of my career, you know, all the problems that came into the company landed on my desk. You got an upset customer, I'm the guy who calls, right? Okay. I kind of just became a master of diffusing situations, calming people down, talking them through it, and then finding a solution. Whether, you know, sometimes if the customer's wrong, actually more often than not, the customer's wrong and they're still upset. So you have to finesse not being taken advantage of, walked all over, you know, defending the business, but also making sure you're not getting a bad review online, like all these different things. And sometimes you have to give a little more than you should. But normally people just want to be heard. You let them puke it out, just agree with them. It's like the first rule of sales is just agree, you know, all these little things. But I just have a lot of patience for personalities. So, and I like doing it. I like spending my time talking to people, not sitting in spreadsheets and underwriting deals.
Fair. So how is Pitch Equity different from like 1864 that's here in town, the fund group that's here? I don't know if you know anything about that fund, but or a separate fund that's here in town, like a startup NV kind of game.
Yep. Yeah, those are that's a venture situation, right? So they're investing in seed, early stage businesses. We don't do that. Pitch Equity is mostly real estate. About 80% of the fund is buying real estate. You know, it's the easiest thing to understand. It's very simple to raise money for. And it's slow and boring for the most part, unless what makes us different is you have a Scott Boroff who's got access to some of the best deals you'll ever see because of his investment banking relationships for being on Wall Street for 30 years. So like the deal we just did, it's called the Bend in Chattanooga. It's 120 acres of waterfront right on the city that hasn't been developed. The CBRE appraisal came in at $131 million. We bought it at a $26 million valuation, right? So, you know, they say the money's made when you buy in real estate. So our limited partners who, let's say they put $100,000 in, their equity was worth $577,000 on day one, and we haven't even developed anything yet. That, to me, is a competitive advantage. Most of what you're going to see in the marketplace with real estate, people are going to say, we're buying this asset. You know, we're going to force the appreciation through rehab and all this stuff. And, you know, they give you a lot of targets, but they don't tell you, hey, what can we flip the property for when we buy it? To me, that's where the value is you're acquiring it here. Who's willing to buy it for more and how much more? And then you kind of know, like, what real discount are you getting in the marketplace? You know, for us in the Bend, we could probably flip that real quick for a triple right off the bat.
If you really wanted to just not develop it and be out, then you could.
Right. And that's how you protect your investors.
What are the rates looking like for you? Are they different for you than they are because of the relationship that's there than maybe what I'm going to see as a individual homeowner?
On just borrowing rates?
On borrowing rates. Because like if I'm going to be going with this guy who has some good connections probably in the IB world, like I would imagine I'm not paying, like my interest rate isn't very high, I would assume.
Yeah. I mean, there's a lot of ways to look at this. It's not just the rate, but the access to the type of lender that will even lend on your project, right? So a lot of times the rate might be, let's say if I want an unguided revolving line of credit, meaning you're going to give me the money, blind pool, essentially. You don't even get to know what I'm buying, investing in. Like you're going to pay a higher rate for that. Yeah. But the access to that is through your track record and, you know, all these other factors. So, but yeah, banking relationship helps, but I mean, it might help you a quarter point, a half a point.
Really, that's it.
Maybe a little, you know.
Huh. I don't know why I thought it was going to be like significant. Like Apple buys debt at like 2% or whatever it is. I thought it was going to be similar for you guys as well, where you're buying.
Yeah, at different levels. I'm sure it gets better. And again, it all comes down to relationships, right? And that's why you raise private capital is because you don't have to answer to a bank or, you know, an institution. So a lot of people would prefer to pay their investors more to just have the freedom and autonomy to move quickly, right? That's why we raise capital into the blind pool debt fund without even knowing what we're going to buy yet. And we got to tell our investors that it's like, hey, you don't even get to know what we're going to buy. But because you give us the capital up front and we have it sitting in cash, when the best deals do come up and there's a lot of competition for them, guess who wins the deal? We do, because we can close the fastest.
So sounds like a pretty good fund to go with. Is that typical of most funds? Is that what they try to do?
No, I think most funds, especially in real estate, are going to, get a deal under contract, right? They're going to do all this due diligence, underwriting, they're making offers, they get a deal under contract. Now the clock's on, right? So now they have a certain amount of time to raise that capital to get that deal done. There's a lot of pressure.
It's rough.
Very different than the way we operate, right? It's like the deal we're raising for right now in Knoxville, we already own the land outright. There's zero pressure at all. There's no timeline. We don't answer to anybody. When the capital comes in, that's when we'll develop the next phase, right? So it gives you a lot of leverage. I mean, if you've done a lot of limited partner investing, you've probably had a situation, I've had this before, where you deploy capital into a deal and then they can't get it closed and they have to send it back to you.
That's a shitty existence.
Yeah.
Like, I could have done something else with this money.
Yeah.
Wow, that kind of sucks.
Yeah. So we got a $2 million piece of land that we bought that's worth $7 million, right? I mean, we're going to develop it and then sell those lots off to the builders. And there's enough spread there. I mean, we'll pay these investors a 25 to 50% internal rate of return in less than 2 years.
And that is the ideal situation for a fund, right? 25%. I mean, that's fantastic,
Yeah. I think beyond that, you're getting into greedy territory. The too good to be true stuff. Now, there are investments that do pay more than that. There's oil deals, data centers, all these, sexy things, but there's caveats to it, right? Like your principal is gone on day one, right? And you make a higher return until the oil runs out or until the data doesn't, whatever those deals are. So a lot of times I think novice investors are going to look at targets and sexy slide decks that are going to say, 40% return. But it's like, yeah, but you lose all your principal. Like it's a lot less than that. So the IRR number to me is the most important. That tells you what your true return is, factoring in the amount of time it takes to get it and if your principal's coming back or not.
Do you do any discounted rate of return? Are you doing any cash flows, any of that stuff, or you don't even touch that and you have other people doing that kind of DCF models at all?
No, I'm not doing any of that.
What a life. I've been studying DCF models and all these and M&A models, and it's fun, don't get me wrong, but to not even have to touch them and just deal with the relationship sounds like a pretty good time.
Yeah, I've done that with everything, like our marketing business that I'm in, the fun stuff. Like I'm always looking for a partner who's ahead of me, that's done it if I'm going to get involved in it, rather than starting from scratch and figuring everything out. I think it's one of the biggest cheat codes in life is to leverage other people's time and experience, and taking something smaller of something bigger, where we can go a lot further faster. And not only does it increase the likelihood of success, but it's a lot more fun, I think.
That's fair. What's the difference between a REIT, a family office, and then a private equity fund?
Yeah, a publicly traded REIT, real estate investment trust, is essentially a watered down, diluted access to the real thing. It's kind of like the stock market. Like the difference, if you buy a stock on the public market versus you were a private investor, it's just the more accessible the investment is, the more diluted the return is. A family office is just a wealthy family that, instead of deploying their capital elsewhere, said, we're going to do this in-house. We're going to get our own attorney. We're going to get our own estate planner. We're going to get our own asset managers and basically create a little in-house fund. And they all operate differently. Some of them deploy their capital. Some of them are still raising capital for, their own deals, or, there's a lot of ways to set up a family office. And then above that is institutional level.
Got it. So I had a client who was Oldham Goodwin was their real estate portfolio, but they owned a family office and they would just do a bunch of deals around hotels.
Yeah.
They liked hotels for whatever reason, like luxury hotels, boutique hotels. And so it kind of sounds like that's moderately similar to what you guys do, but not entirely. And so and there's no way to know how exactly they operate versus how you guys operate, right? It requires more conversation, but it just sounded the same. And so that's why I wanted to ask.
Yeah. They're going to have oftentimes a family office is a wealthy family that wants to just have it all in-house. So they're going to put experts in place for all these seats. And then, when we deal with family offices, what you run into is they have their buy box parameters, right? You got to build a relationship with them. Some of them only want to be X percentage of your fund, but they only write checks of, let's say, 5 million or more, right? So that means if they want to be 10% of your fund, but they only write checks of 5 million or more, you already have to have 50 million under management for them to even look at you, right? So you gotta like finesse these relationships and figure out which ones you can even work with at the stage of the game you're in. So for most of us starting in the fund world, you're going to be going to retail in the beginning. I would say to get your first 10, 20, 30 million, it's got to come from retail for the most part.
What is y'all's AUM, if I can ask that?
This new fund?
Yeah.
I mean, we just launched this fund, so we're at about 4 million.
Nice. And what is the goal to get it, like an ideal situation here?
Yeah. We want to be at 100 million by the end of the year.
It's quick.
It is quick, but we got ambitious targets. So the first fund I launched with some other partners, we went to 20 million in the first year. 0 to 20 fast. We had a trading fund that was doing extremely well, and then we had a really sexy late stage private equity fund. This was in 2023, 24 timeline, or no, 22 through that period where interest rates were super low. People could borrow at 2-3%. If you could provide a high return, it made a lot of sense for people to borrow money to get the return. It was just a much easier environment to raise capital. Real estate syndications were super hot. That was the thing everybody wanted to invest in. We had access fund to fund with a late stage private equity firm where we could get into things like SpaceX and Flexport, late stage unicorn companies that are really hard to get private shares of. We were offering that to retail. So, they were just getting swallowed up fast. And that's one thing I learned about raising capital early is that if you're having a hard time raising capital, it's probably your deal. If you really do have the best deal in the marketplace, the money's going to find it.
Makes sense. Everybody wants to make money, so if it's good, it's going to sell.
Yeah. The SpaceX shares sold out so fast, we had to return money to people.
How does that work? What do you mean?
Oh, the money gets wired in, and we couldn't fill the shares. They got taken, and we had to say, hey, sorry, we're going to wire your money back.
You guys had a 1,000 shares you could sell, and people spent, or you had 15 people that wanted, or 1,500 shares to be sold, so you had to give back 500.
Yeah, so this is the fund to fund model, right? So we're going fund to fund with an Innovation X. They're somewhere around, I don't know, $5 billion under management. They were pre-IPO on Spotify, Lyft, Airbnb, Palantir. Look at Palantir. They, some of the best investments you could make in the last 10 years. They were in all of them. So. They might sit on the cap table of those companies to, let's say, $100 to $500 million is their position. And then when they raise more money to go into these investments, they're going to go to these smaller fund partners like us and say, okay, you get $5 million. That fund has the capacity to raise 20 because they'll raise this in 30 days and then deploy. So,
God damn.
Yeah.
All about relationships. You don't do it otherwise.
All relationships. And that fund to fund relationship, we were a brand new fund. We had no business getting that relationship, but it was a neighbor of my partner, and they lived in they played
pickleball together.
Yeah. And that's how it happened, right? And he said, I'll give you guys a shot. I'll give you the first one we did was a $3 million slice. And we got that one raised, and he's like, all right, we'll give you a little more,
That's insane. So you're new to here to Vegas moderately, right? Yep. How do you find the right people, and what does the market look like here in Nevada right now?
It's really tough right now. Raising capital is really hard right now. Everybody's scared. Everybody's dealing with inflation. I don't care where you are on the ladder, you're dealing with it in your own way. Everybody's been thinking real estate's going to crash for several years now. It's just not happening. It's kind of staying there. There's something like $100 billion sitting in funds right now in cash, waiting for the commercial real estate crash that just keeps not happening.
Damn.
It's just the banks they're kicking it down the road. So I think everybody's patiently waiting for opportunity. But I've looked at a lot of data, looking at the 2008 crash. This is a little bit different. This time it's on the commercial side. That was residential, but it's very reminiscent. The default rates at Freddie are already worse than in 2008. And we're pretty much close, I think, to the bottom of real estate trending back up. The latest stuff out of the Fed, too, is we're getting 3 rate cuts between now and the end of the year. So I think now's the time to be deploying capital.
Then why aren't people deploying capital? Why be so afraid if this is the bottom of the market?
Well, I think there's different. If you're a retail person, it's the time. Now is the time. If you're a big institution, you're waiting for some of these big real estate projects to hand their keys back over to the banks and buy them for pennies on the dollar, which is, I still think that's probably going to happen in some capacity. It's already happening because if you bought some of these deals, I'm in a few of these that were bought in 22, 23, peak rates, interest rates went crazy. If you were on a construction loan, variable rate. You're buying rate caps. You're doing all this stuff to save these deals. Your NOI is getting swallowed up by insurance costs going up, and all of a sudden the value of these properties are plummeting. I think, that's what those funds are waiting for, is to be able to buy these distressed assets. But the banks, they don't like, foreclosing on them and having to go through that process. So they're giving a lot of concessions and more time to all these operators to try and get them to make it work.
How long can they keep doing that?
I don't know. I'm shocked that we haven't lost a couple of the deals that I'm in so far.
What is those deals were the ones that were purchased in 22 during that time. And so those deals that you are in, what are you waiting for? If you're in the deal, there's not much that you can do outside of just wait and see what the decisions end up becoming. But like in an ideal situation, it just goes away and it's like, okay, we're okay. We're not going to default. We're going to be fine.
Yeah. I mean, every month, the mortgage is getting paid down a little more, and, rents are still increasing, right? So you're trying to force some appreciation, force some rent growth, and you just hang on, right? Like, cause you can't sell these assets right now. You'd sell them for, more than 50% less than what you paid for them. So the only way to get out of them is to get the NOI back to where it was. Then you could get out, at a break even. So I think it'll be a couple years until we can get that done. As long as we survive the NOI bleed that we're in right now.
That sounds fucking stressful as shit.
It is, but another thing I've learned about investing, like if you're going into this private placement space, like you're going to make a bad investment at some point. Like it's going to happen to you, right? So asset allocation is the most important thing. No matter how much I love a deal, I don't put a ton of money in it. I'm very disciplined, because what I learned through this process is the real estate deal I was the most hesitant to do was the best performer, and the one I was positive on ended up being the worst. So, markets shift, things change. A class, B class, C class, spread it around. Don't be too heavy in one part of the country. Don't get too concentrated with one partner or operator. Like, these are things you can do to mitigate your risk. And then, you only have to be right a couple times to make crazy returns. So don't worry about, losing a couple deals. Like, it's going to happen along the way.
It's out of the 10 deals that you do, one of them will hit that ridiculous return.
Yeah, and that's like the VC side, right? It's like they're going to make hundreds of them, and if they get one unicorn out of it, it was worth all the others going to zero. Yeah. So you just got to know the game you're playing. I think for most retail investors, you're better off, staying to the real estate type stuff, or people that are just scared, that have their money sitting in a money market right now. Rates came down a little bit. You're probably getting 3.5% on that. You could put that into our debt fund and make 16, right? And it's a debt instrument, which means you're in first position ahead of the equity investors, right? So if the deal is not performing as well, the equity people take the hit. You still get paid, right? So it is the safest way to be in the most aggressive investment space.
How can you pay a bond at 16%?
So we paid at 12, right? You can pay whatever you want. It's a private debt fund, right?
So you can just fucking, like, I'm paying you 5% each shit.
Well, no. Like, this is a contractual fixed debt offering where we pay 1% a month, right? Okay. It's kind of like a hard money lender. They usually are somewhere around 12% with some points or whatever. So we're saying, hey, investor, like, if you need cash flow, come into our debt fund. We're going to pay you 1% a month. And then at the end of 5 years, here's your principal. We'll give you a 24% kicker on the back end. By then, we've had enough time to make enough return to pay that 24% on top of the one, monthly.
What's your minimum for that?
100K.
It's not bad.
It's great.
That's pretty nice,
right? But it's not going to be. And what I tell a lot of people to do, first of all, I'm never giving investment advice. It's just like, this is an option for you. Yeah. We only raise money from accredited investors. You do whatever you want, but splitting it between equity offerings and debt offerings, I think, is a good way to hedge yourself, right? Because the equity side is always going to pay you more if we hit the targets.
And then there's
an unlimited upside, right? Like the bend, we're being so conservative with our projections. Same thing with Lions View Estates in Knoxville. We're saying 25 to 50% IRR. 25 would be like if it was a disaster. So, we just want to, over deliver on the promises, because that's the most important thing to the longevity of your fund, is to deliver for these investors so they keep their capital churning with you. And that's how you get bigger. They tell their friends about the great deal, and then it's just once you get through that first 10 million raised and you're doing well, then it gets a lot easier to raise capital. In the beginning, it's so hard.
Did you put the proceeds from your sell into starting your own fund?
Yep.
That helps.
It does. Yeah. That's another great question is, how much money are the GPs putting in the deal? Right.
Yeah.
Because if something's challenging, for instance, like you can always close a fund and just write it off and send the investors a K1. Like it was an accredited 506c deal. That's the risk you take. Right.
It's not good for your reputation, but
not good for your reputation. But if the GPs have their money in the deal, they're going to fight a whole lot harder.
Yeah.
Right. I mean, you would hope they would do it anyways, good stewards of capital, but that's just not the reality of the world, especially in the greedy money world. Like you need to know you're with operators that have integrity.
So are you a fiduciary at that point? Like, right? Like your job is to take care of the investor, but you could also just be like, oops, sorry, we didn't do very well.
Fiduciary as a concept versus fiduciary responsibility. If you're like a financial advisor or an RIA, it's a very different thing, right? Very different thing. So that's why when you start a 506c fund, that means anybody on the way in has to be an accredited investor, which means the SEC defines them as completely 100% capable of making their own investment decisions. If they lose all of their money, there's zero liability on the fund. Like that's what you got to know going in. So knowing that, you better be with the right operators.
So is it a lot of conversations with the operators before, like, how do I, or just somebody knows somebody's had some trust already, and that's usually how you get your, is it referrals?
Yeah, track record is huge, but I hadn't, I'll tell you, I had an experience with a guy who had over 20 years, done over $1 billion in real estate. I thought he was the most solid guy. Made it through 2008, didn't lose any deals, never missed a distribution to his investors, put a bunch of money in a couple of his deals, and then in this recent real estate cycle, he committed wire fraud because he was trying to save a deal over here. He was moving money from another deal.
Damn.
Right. And he was like, oh, nobody will know. And this is usually how fraud happens, right? It's somebody who's trying to save something and they don't, it's kind of somewhat innocent. I don't see it that way. Like compliance to me is black and white. It's inexcusable to do anything outside of your fund documents. Yeah. There's no amount of money that's ever worth breaking the law. So, but yeah, I mean, he did it and kind of pigeonholed in that deal.
So what happens to you as the investor?
Nothing happens to me. We try to save the deal, and it's like, hey man, like you better save this deal if you don't want us to potentially have you criminally prosecuted.
I was gonna say you have to go through, I would imagine, some sort of litigation.
Yeah, I mean it's an option, but let's be serious. I mean, unless you've been through litigation, which I have on this stuff. I mean, if you lost, I think you'd have to lose at least $500,000 or more to even consider going through litigation because it's going to cost you that anyways.
Yeah. So it wasn't even not that.
I'm not litigating that guy. Okay. I mean, he's got a couple $100,000 of mine. Like
it's not worth it.
I just hope the deal works out. If it doesn't, I'd rather write it off and move on because it's also a lot of time and energy. Litigation's terrible for everybody involved, and usually only the lawyers are going to win.
It's nice to be a lawyer.
Oh, yeah.
Did you go to school?
Yeah, I didn't finish, though.
What'd you go to school for? What was the initial intention to go to school for?
Oh, just so I could play hockey.
Nice.
I got into college with a 1.9 GPA. The athletic director walked my application down to the dean's office to push me through. They were like, we need this guy on the hockey team. And as long as he can get good enough grades to stay eligible, we'll keep him.
And how long did you last?
I was there for 5 years, no degree.
Nice.
Yeah.
You
eventually just dropped out.
You took the extra lap around and didn't finish.
Man, I didn't know what I was doing. I was
You're
so
partying,
lost at that
imagine.
point. Oh, partying like crazy, failing all my classes, summer and winter classes just to be eligible to play hockey again.
Yeah.
It was brutal. School wasn't for me.
School's hard, and for a very different reason. It's my first semester at A&M. I think I finished off with a 0.8 GPA, and I was like, wow. This is weird. Like, I'm here working in a lab doing research, and then I was competing for Team USA at that time, and then I still have to go to class. Classes just seemed like such a fucking boring thing to do versus like I'm killing rats and doing research. It seems like real work versus like take bio 101. Like, what a waste of fucking time. I did end up finishing it. I'm in school again, but I think school's not it's not for everybody.
I think it'd be different if I went back now.
Would you go back?
No.
What's the point?
Nah, it's like my badge of honor. Like I want to be as successful as possible with no college degree, as just proof that the limiting beliefs, because that's what I believed at the time. I was like, if I don't get a degree, I'm going to be worthless. My life's over. That's what I was kind of like raised to believe. You have to get a degree.
Yeah.
Just couldn't be further from the truth. And then when I found sales, 100% commission sales, like I've always been 100% commission in anything that I do. What I realized was that I have to be incentivized by the result, and I have to want the result, or I'm literally worthless. Right? Like if you gave me a salary to do something, I'd be the least productive person ever. I wouldn't know how hard to work, because it's like, wait, you're going to pay me like a fixed amount
just
of money
to exist?
Like, no, I need performance indicators directly tied to my comp.
Is that how you pay people as well? Like I assume you on your team, like are there performance indicators that everybody gets paid off of, or or you have salaried people?
Totally depends on the role.
Okay, yeah, fair.
Yeah, I mean, account managers, it depends on the business too. At our marketing business, they're paid per account that they manage, so it's like a time-based pay. But yeah, anybody that's driving revenue, yeah.
How many different businesses do you have?
I'm involved in 3 right now.
Okay, so marketing business.
Yeah, that's Kern's
Pitch
Marketing, Pitch Equity, and then Safe Space Global. That's the public company.
Okay, and so the first one was what again?
Kern's Marketing.
What does Kern's Marketing do? What do you guys specialize in?
Social media.
Social media marketing.
And digital marketing. Yep.
So I'm a potential influencer person that wants to grow their page, and
yeah,
I'm gonna call you and say, hey, can you help me grow my page?
Yeah, we do everything, but it's born out of, so Cody Kearns is my partner, and he's been doing this since 2015-ish. He was on Grant Cardone's show, went into marketing, and he's got all these relationships, right? Like we're doing a collab with Floyd Mayweather next month. He's going to put up a post with a bunch of signed memorabilia, and he's going to give it away. And to be entered to win, you got to follow our list of accounts, which will be our clients, and they'll get 20 to 40,000 followers from his brand overnight, right? So we have all these different strategies and ways that we can build brands out of thin air. What I don't like to do is work with somebody who's faking something. I like to find people who are studs in the real world, and their presence online just doesn't do them justice, right? So we'll get them published in USA Today. We'll do their Google Knowledge Panel.
What is a Google Knowledge Panel?
Google Knowledge Panel is when someone Googles your name or business, you own it. And it pops up differently. Sometimes you Google something, there's this whole thing at the top, and there's like a quick facts and pictures. Like if you Google my name, you'll see it pops up and it says investment fund manager. It's got pictures, and then it's got a whole like bio within
like wiki, kind of like on the right side where
right. That's big credibility when people Google you. So you set up all those things, you build their social medias, we do all the content creation. We've got 15 editors on staff, so we're full service, build you a brand. And a lot of clients, they have some of this built, some of it's not built. How big do you want to go? And then we've got all the resources to make it happen.
That's pretty wild. And then do you guys do like podcasts, like rounds with people? Like, well, we have a network of individuals, we can get you on like these 10 podcasts.
If it makes sense. Yeah. That's one of my favorite things to do with a new client is put them on a podcast tour, especially depending on what they do. Right. So for me, when I broke into capital raising, that's the first thing I did. We did DM outreach from my Instagram account and put me on, 20, 30 shows. And that's how I raised the first 10 million. It was it was pretty much all inbound, right? From the exposure of being on these other big stages and leveraging other people's brands. So, I mean, between stuff like that and, we can scrape follower lists. So like if you're the person that you want to do business with follows a certain type of page, we can go scrape all those lists, and we use AI tools to send out 2 million DMs in a week for you, right? Like we can do all kinds of crazy stuff, but, yeah, most people just don't know that this stuff exists.
Yeah. Being in this kind of space has definitely taught me a lot about that kind of stuff. So I guess my next question is, what is the commitment that you asked for from the client?
Not much. I mean, if they're doing a podcast tour, they obviously got to do the podcast, but we put a manager in the back of your Instagram. They do all the research, send all the DMs. We can set it all up for you. A lot of times it's not even podcasts. They just don't even have, content on their page. So what I'll do a lot is book an hour of studio time like this and say, hey, fly out to Vegas. I'll interview you for an hour. And then that gives us, 2 months of content. And then I'll collab it with my page, right? There's all these other things we can do to leverage other brands to get your name out. It just depends on the industry and what they want to do, but it's not much of a time commitment at all. We pretty much do everything. And DM outreach strategies are are how we're monetizing. That's by far the cheapest way to monetize on social media. And if you want to run ads too, that's great. That's the next layer. But if you do the branding right up front, the ads and the DM outreach convert at a whole nother level.
How fun. How cool. Who are some people you work with now? I know obviously you said Floyd Mayweather was like one of those people. I know you said you were in the podcast studio not too long ago with another one of your clients. So then who was that individual that was doing on Sean's podcast?
Oh, who was it? That was Nathan Danner was in town for Sean's. Yeah.
Who's Nathan? What does Nathan Danner do?
He's a real estate guy.
Man.
He's a KM client. So when he was doing Sean's podcast, he came into town. I live here, so I was like, yeah, I'll pick you up from the airport and drive you over there. You know.
Do you plan on staying here for a while?
I don't think I'm ever going to leave. I could see myself splitting time. I spend a lot of time in Nashville right now. Nashville's awesome. Not a huge fan of the weather, but
fair.
The winter's bone chilling and it's humid and hot. But I think a perfect 1-2 punch would be Vegas most of the year, and then either down to Cabo for the winter, or maybe South Florida, something like that.
Nice. I know Memphis isn't the nicest place, but they have great barbecue.
Tennessee's a gem. I love Tennessee.
I love it. That's where I got my master's at East Tennessee State University, just right over in Johnson City, and so spent a little bit of time over there, and I really enjoyed my time. I do like the humidity though. That is because I'm from South Texas. I mean, I miss the humidity. Being here is hot and dry and fucking sucks sometimes.
It's so funny how bio-individual, how that changes. Like, I love it. I've never felt better than being here in the dry heat.
What is a turn off as soon as you start communicating with the company or a potential deal? Like that's a big red flag for you?
For me, business in general is about a feeling. It's changed a lot. It's less about can we get the results, but are we going to have fun getting those results? It's all about like the vibe. Like if you get real salesy on me, like I'm out instantly. Like if you're like, are all the decision makers going to be there on the first meeting? It's like, can you take me on a date first? So those are things I look for. If you make me feel awkward, you make me feel weird, like I'm just out. Like I just don't need it, People that are just obnoxious or assholes to people or treat their employees like shit, like I don't deal with any of that. So for me, it's business should be fun, and the world's a whole lot bigger than people think. You don't need to ever feel like you need someone or an opportunity. If it doesn't feel right in your soul, you should probably just walk.
It's okay to say no.
Yeah.
It's more than okay to say no. There'll be another opportunity, 100%.
Yeah.
I have a couple questions written down, so I'm going to look back at these questions every so often. What does a deal process look like from start to finish?
Start to finish deal process. Okay. Well, we got to look at, as Scott says, we typically look at 100 to pick one.
Okay.
So it's going to be just the initial feasibility of the numbers. We want to see it in person. We're going to go out and see it. We're going to Georgia next week to go look at a golf course resort. Scott's going to look at all the preliminary numbers, the players, and, does it even make sense for us to go look at it? And, is there a way to negotiate it into our buy box? That's number one. Then we're going to go look at the asset, see if we like it in person, get your eyes and hands on it. And then you go into negotiations, right? On how are we going to do this? Are we buying a percentage of this project with something as big as the Bend? We're talking over $4 billion of total development in that project. There's a lot of different players involved. So it's like, are we going to get along with these players? And then you got your lawyers looking at all the details, like who's got control? What are the percentages to have control? How much of the deal can we buy? Like, it's managing all that stuff and then actually getting the capital raised, ready to deploy, and then, closing on the deal, which that last piece, that closing on the deal is where things sometimes get really hairy and, people try to pull things, and it's just, we make it sound really simple and easy, but none of this is easy.
So then deal closes. Then what do you do? How involved are you with the process after deal closed?
Me personally, I'm not going to be very involved at all. So I'm not on the operations side. So depending on what it is, like with something as small as, let's do a simple one, the Knoxville deal we're doing right now, that's just 4.5 acres, undeveloped land right on the water next to the Cherokee Country Club. It's a $20 million house being built next door. We're going to build 4 or 5 million-ish houses right there. Scott's in charge of managing all of that with his partner, we got to put a road in, so he's going to get the contractors there. He's lining up the builders we're going to sell the lots to. So he's going to manage all of that. while he says, hey, here's the next deal we pick, go out and raise money for it.
Got it. That's a kind of a cool situation. I kind of like being Scott, but at the same time, because I like the operations side of the thing.
Yeah.
But at the same time, being on your end, we're like, okay, I'm in the deal closes, I'm on to find the next one. Both of them have their unique stresses. Which one would you find to be more stressful?
I think his role is way more stressful. You know, but he would probably say the same about mine. That's what
Which
makes
is why you're
partnerships work. Yeah. I mean, what's hard for me, it's like if I'm out, you know, I'm speaking on a stage last weekend in San Diego, and then it's, you know, doing media today, and then it's, you know, Zooms all day, not just on capital raising, but big strategic partners finding big deals. I'm not the underwriter, but I'm the one who's finding these relationships and then saying, oh, you guys let's go meet with Scott. You know, we're talking big family offices that say, hey, I got 20, 40 million to deploy. You know, that's an exciting thing. I'm the one who goes out there and finds them. We've got DM outreach going on LinkedIn. We've got, you know, all the media. So I'm pretty much, you know, front facing, building the relationships. And I'm sort of a filter too for Scott. Like he's not getting on all these meetings, but we run DM outreach from his LinkedIn to say, hey, meet with my fund manager. And that's me. I'll meet with 20, 30 people to say, hey, this one's worth you meeting with. Let's, you know, take this relationship to phase 2, which is meet the GP. And it works really well for all of us.
It sounds like a sales job. I mean, it is a sales job.
It's 100% a sales job.
It's not a bad sales job. It's a high rate of return on a sales job.
Yeah. And then in between that, it's like on Instagram, we're slinging marketing, right? And, you know, I'm selling in the DMs. I mean, I have a manager that helps me, you know, manage my DMs, but, you know, they're putting, you know, potential high ticket marketing people on Zoom with me. So I might be on a pitch equity Zoom, and then a Kearns marketing Zoom, and then a safe space Zoom, all in the same day, right? And the businesses are in different time zones. So I'm usually on Zoom by 6, 7 a.m. every day. Yeah. And I'm still answering my phone at, you know, 6, 7, 8 at night. Like it's just it's a good lifestyle because I go to the gym in the middle of the day.
Yeah.
Like I went and got 30 minutes of sun, swam some laps in the pool midday today, but I still did all these other things, you know?
It is a pretty good. I mean, being in sales is nice. I mean, I sold custom homes for a little while in Texas, and I enjoyed that lifestyle quite a bit. Outside of like whenever you don't have meetings and you're just like trying to fucking find people, that can be tough.
That's the hardest part. When you're lead dry, it's the worst.
It's hard. I mean, it was in the middle of. It was, I guess, right after COVID, and so I like during COVID, kind of, I guess 2021 ish. And so, I mean, rates were great. And so it was still selling like hotcakes, but I'd have a week where it was just like, I had 30 sales this week. And then all of a sudden next week, it's just like, okay, now what the fuck do we do for a week? Just trying to hopefully message everybody that I possibly can. And that can kind of drive me insane a little bit. So I ended up moving to the operations side, and I really enjoyed the operations side as well. But I did both at the same time. Either way, I had a good time in sales. It does create for a nice lifestyle.
Yeah, it's definitely like everything's a trade-off, right? Yeah. It's not as stable. It's very like this, but it's also way more exciting, you know? And I kind of like that. I kind of like getting frustrated and being like, oh, I'm done. You know, we're just not raising right now, like whatever it is. But you just have a short memory on all these things. Then all of a sudden you have a good week and you feel great again. And like it sometimes like right now is one of those times where it's like, we're just not really raising much this month. And it's summer, you know, everybody's just not having meetings, and the kids are back in school right now, and I feel like it's going to pick back up. Yeah. Sometimes I forget, like we raised 13 million already this year. It's like, but the way the sales brain works is like, yeah, but what did I do yesterday?
Yeah. There was no sales recently in this last 2 days or today. There's no meetings or whatever. Like the meeting wasn't fruitful. So then is it really real? No, inside the sales brain, it's not real. The last 13 million doesn't really matter, which is weird. It's a weird idea. It's really like, weird. I would imagine most people are just like, oh, fuck yeah. Like, but I hit 13 million 6 months ago. So then what the fuck? Like, so it's okay to have a bad day today. It's like, well, you have too many of those bad days, and all of a sudden now you have a month of bad days, and then now you only raised $13 million this year because you were okay with having a couple bad days, right. Which is it's constant, which is not bad. It is what it is. More questions. So, what's one of the toughest deals you've been involved in, and what did you learn from it?
Toughest deals, man. I've had a few that are really tough. I'm gonna say the one in Atlanta that we're probably going to lose. I'm a limited partner in this one. So this one was one that was bought in late 22 and on a construction loan. We had a compounding thing. So inflation, like it's in Stockbridge and it's a pretty lower end apartment complex. And when inflation went crazy, people stopped paying their rent, like a lot of people. And it was also in a county that had a not so tenant or let's say landlord friendly judges and politically a big mess for us. So you'd go 6+ months of somebody not paying their rent and you can't get them out. And the court systems are backed up, and there's no end in sight. Your NOI is dropping. You feel bad for these people because inflation's kicking their ass and they can't pay their rent, but like
you can't
lose your deal.
Yeah.
So it gets real hairy and insurance costs went up, rates went crazy, and that was a variable rate construction loan on a value add deal.
Rough.
So that deal, if we're lucky, 5 years from now, we could probably get out even on it if we don't lose it altogether. And it's just part of it, But there's a lot of lessons there, Like,
what'd you learn?
Number one thing, I will never invest capital into a liberal area like that ever again.
It's fair.
Like, it just is what it is. Like that, the court system stacked against you. It's not like a left or right thing. It's just the court system stacked against you. Why would I invest there? Yeah. It just doesn't make sense,
So don't go to California.
Yeah, I would never go to California. I was in California last weekend. It was just mind blowing, like Newport Beach, and we were in San Diego and then went to Newport, and I just couldn't believe just the real estate is insanity. Just absolute insanity out there. Like you're spending $1 million to get a little condo, like 1,200 square feet.
We were in La Jolla. We were right on La Jolla Cove last week as well, like last weekend for Del Mar for the races, the horse races, and we were looking at houses and like, oh man, like that one's right on the water. That one's $2 million, and saw the pictures and they were really nice. And then my fiance was like, look at the square foot. And it's like, oh, it's 700 square foot for $2.2 million. Like, what the fuck is this? Here I was thinking like, oh, it's not that bad. Like, I get it. But like, no, that's fucking insane. That's a shoebox. I don't care how close I am to the fucking water. I'm not going to spend $2.2 million on a fucking house. It's crazy.
I actually looked this up. How many homes do you think in the U.S. are valued at $5 million or more right now?
Percentage wise?
No, like a number. How many?
Oh, number.
Just how many?
Let's say 5,000.
Over 400,000.
What the fuck?
Right?
What
now
percentage?
it's less than 1% of the homes. Right?
Sure.
When you want to look at percentages, but I hate percentages when we talk about stats.
Okay.
I can get into that, but so I'm looking at that and I'm like, there's over 400,000 people. Well, I'm sure it's probably less than that because they own multiple of them. Like once you get a certain level, it's just so easy to get to the next level. But that's wild.
That is pretty wild. Where the percentage of, we don't like percentages. How many of them are in California?
That I don't know. But I mean, every city I go to, it's just like go down to Naples, go to the, Florida. I mean, even Texas everywhere on the water. Lake houses across the country. I mean, the amount of wealth and abundance. Yeah. It's nuts. It's everywhere.
I was at Miramont Country Club for a couple of years, and it's a privately owned country club. So the guy, his last name is Adam, and he owns a house there. It's 30,000 square foot. And then he has another one that's $30 million in Syracuse, New York. And he has another one that's another $30 million home in Florida. So I think, once you can afford one of them, you can definitely afford usually a couple of them. And they usually buy them in plentiful amounts. I don't know why I would need 30,000 square foot homes, but if I have them and I have the equity or I have the cash to do it, I guess why not?
I thought that was an interesting thing too. When you look at ultra high net worth families, they keep more than half of their net worth in single family homes.
I don't know that I consider 30,000 square foot a single family home, but technically it is.
Yeah.
But
most of them have, $5 million houses across the country, or whatever it is. I'm sure they all do it differently, but I thought that was interesting. You would think they would have more in the markets.
I had one of my clients owned a lot of homes, and they were like the 5 million plus kind of range. His mentality was, I am my own bank. At any point in time, I can sell that house and I can just immediately come out and then I can do whatever I want with that cash. It's safe. It's likely to appreciate. And so they were just all over the country. So if you just, we're not going to go to Colorado anymore. Let's just sell the house. Then we have $5 million to spend on whatever else. So it's definitely very common.
Potential tax issue there. So my preferred strategy, this is what I do. Any single family home I have, I put a HELOC on it right when I buy it.
Immediately?
Yeah. Yeah, you don't have to use it, right? It's a revolving line of credit. So when I need cash, I just borrow it out of my house and then I pay it back in, and you pay the interest only for the time that it's pulled out.
Huh.
Right? So if I sell a house, now I've got a taxable event, logistics, all that stuff, debt's never taxed. So I'll just borrow from my assets until the end of time.
Huh. I always I've played with the idea of a HELOC, but I was like, I don't know, I'll do a HELOC later. I've never thought about placing a HELOC immediately.
The reason why, I don't even know if you can get them. I haven't even looked at it because I always do it when it's a primary residence before I turn it into a rental.
Fair.
Right. You get a better 30-year rate, and then you get an owner type HELOC. I don't know if you can even get HELOCs on investor properties. I don't know. I have to look into it.
Technically, I spend most of my time. I have a house in Texas, and so that's the one I was thinking of. We have one here, but that one is mine. And so I was like, well, I mean, that's the one I've been considered about doing a HELOC on. I have a friend living in it. It's not really and I don't really charge the actual full amount of the mortgage. So then it's still technically my house, and most of my mail goes there. But so I wonder if I could still use that as a HELOC option.
Probably could. Yeah, you could probably put one on it. And it's variable. Like it moves with the Fed, right? It's like right now you're paying 8% on a HELOC.
Yeah.
When I originally put this HELOC on my house in Virginia, it was at like 2%. So I borrowed all of it and I put it into different investments that were cash flowing
more than 2%. I mean,
yeah, and just paying the debt and keeping the arbitrage, like no brainer. Like I do that with 0% credit cards. Like you're gonna give me 12 months 0%. I'm gonna max that thing out and just keep all my money in cash in a high yield savings or in a debt instrument where I can get yield. And then when the 0% terms up, I'll just pay it off and do it again. It's free money. It allows you to live 12 months in the future.
It is free money. What a cool idea. I'm going to look into see if I can do a HELOC for that house. It'd be kind of cool. I don't know what I would do with it. I mean, I don't know, some good money to be spent. I don't know. We'll figure it out at that point,
Yeah, at a very basic level. I mean, right now, HELOC's at 8, but the Fed's supposed to cut 3 times by the end of the year. So it'll probably be like 6 to 7, whatever. But I mean, like bridge lending is usually around 12%.
Damn.
Or if, there's some risk with this, but I know a guy who's got a $700 million debt fund. He's only paying his investors 8%, and then he's lending it out on multifamily bridge loans at 12. So he's keeping a 4% spread on $700 million.
God damn.
You know how much money that is?
Off the top of my head, no. A lot.
I think it's over 20 million a year.
Yeah.
But it's like that arbitrage is his business. It's just money arbitrage.
All day. Is that, man, it's kind of what you guys do. I mean, right? With the just at a smaller level, but I mean, at some point it grows.
Yeah. It's just different levels of the game.
Yeah.
That's why when people are like, why does Apple borrow money?
Yeah, because they can get it at 2%.
Most cash on the balance sheet in the world, but why are they borrowing money?
Because they fucking get it at 2% and it's free money. It's
there, and they can get a higher yield on their cash.
Yeah, it's simple. Yeah, it's good. That's so fucking cool. So then, would you ever just make that your business, just arbitrage?
Yeah, I'd love to. You need to get what you need, though. That's got to stack
shit
up.
Ton of cash.
But I think in this, I kind of look like the next 10 years of my career is like really stacking assets. To where it's like undeniable.
Personal athlete, like AUM or like
fund AUM.
Yeah.
Right. Because you got the leverage of other people's money. Like, sure, you make money on the way, right? You got your acquisition fees, management fees. Like there's, the fund takes a percentage of the exits and you make money that way. But yeah, churning the AUM over time, if you're got a 1% management fee on $100 million, like before you do anything that year, you just made $1 million.
Yeah. At what point do you say all right, technically you could probably just be like, all right, I'm going to fucking move to, I don't know, Thailand. A lot of expats move to Thailand pretty cheaply, or Costa Rica, buy a house and all right, I'm done. Why not?
I don't know, man. I think I kind of feel like I'm in that mode here in Vegas. Like this is where I want to be, right? I love everything about Vegas. I don't know. I just don't. I'm more like in a 24-hour process than I've ever been, where I just don't worry or think about things like that. And it's like, because every time you think long term, like it totally gets wrecked anyways.
Yeah.
Right. Like you're probably gonna get somewhere faster than you think, and then you got to recalibrate the goals and the targets, and like I don't even think about it anymore. I'm just like operating what's in front of me, and what that's really allowed me to do is actually enjoy today, because that's been a real struggle for me. Like when you've got big goals, it's very hard to enjoy the time in the present. And I think that's a huge way that ambitious people get robbed of their time on earth, is always fighting for the next thing. So I don't really do that anymore. I'm like, I don't really stress out. If it doesn't happen, it doesn't happen. If it does happen, it does happen. I can't control the outcome anyways. So to put that type of mental pressure, I just don't do that.
It's a pretty good place to be.
Yeah, it's been a hard challenge. And I think what really helps to get there is like you got to like go really hard at something and then take a huge loss. When you take a huge loss, like everything recalibrates in terms of what you think you want out of life and all this stuff. And you start to realize, like, if you, like, I went to the $3 million house, lost a ton of money, back to a condo, right? The coffee tasted the same. The sunrise looked the same. The walk with my dog, man, it wasn't the nicest, the same neighborhood, you know, still makes you want to like be ambitious to get back there and then some, but you start to really calibrate on like what's actually important.
It's good. I like that a lot. I feel like a lot of people get trapped in I have big goals, I want to shoot for big goals, and then the big goals never end, and then all of a sudden you're 65 years old and like, what the fuck did I do?
It's just never going to be as great as you think when you get there.
Yeah.
It's just going to take you to the next thing. Like this I'll be happy when trap is, yeah, it's a tough one.
It's a hard fucking trap to be in, but it happens so often, like almost all the time. Because I think there's this idea, like social media is like, man, you can own your own business, and then you're gonna become a billionaire, and then you're just gonna like live the high life. Look at all these girls I'm with, and look at the private plane, and so you think you're gonna get there, but then you don't realize, or when you think when you do get there, that it will be fulfilling, but then you realize, man, like this is like, what was it all for?
Yeah, and I've just been lucky enough to be around a lot of people who have lived that, you know, 100 million to zero, like, you know, like almost a billionaire. Like one of them's got his jet here on the runway here in Henderson. And he told me, like, when I took my huge loss, he was like, you know, I would give away, I think he's probably worth $500 million. He's like, I'd give it all away just to be your age again. It's like, oh, that puts it into perspective.
It's crazy.
Right? He's like, I would actually rather have less than you. I'd rather have a negative net worth and have the opportunity to just have more time. So it's like we already have everything that we want and need in life. Sometimes we forget that.
So what are the things that you value most today, like in day to day?
Piece of the schedule. That's the one thing that does keep me going, is I don't have 100% freedom of the schedule. You know, there's still things that have to get done. The needle has to get moved here. Sometimes you don't want to travel and you got to go do it. You know, with what I do, it's just so many airplanes, different cities, nonstop. I think I've probably been on close to 50 airplanes already this year. So sometimes it gets annoying, and you just, you know, want to be like, I'm not doing anything today. I'm just going to hang out with my dogs or, like, you know, my wife, whatever. I think I want that complete freedom. There's a partial freedom, but not at the level I want it to be at.
Fair.
Yeah.
I hate flying.
Yeah.
If that's part of the job, then I'm like, no, it's okay.
Yeah.
I fucking
it
hate
doesn't
flying.
bother me, but it is exhausting. Like the time zone changes and not being in your own bed, and
those things I could be okay with. It's like the actual act of flying that I'll drive everywhere. I fucking hate flying.
Does it like freak you out? Like,
dude, I just hate it. I hate heights so much. And then like you hear, like, I'm okay with a big plane. Put me on a small plane and I'm fucking losing my mind. Yeah. So yeah, that's just, I hate flying.
I'm terrified of heights too, but planes don't bother me. It's like, it's the weirdest thing. It's
Must
like
be
I'm more scared of a hotel balcony than I am of an airplane.
What?
Oh yeah, because it's like it's open. Like I could actually fall. When I'm inside that can, I just don't feel like I'm like exposed.
I just immediately think that we're just gonna hit a fucking side of a mountain somewhere, and we're just gonna get. I'm just gonna, like. Unfortunately, I'm not gonna die as fast as I want to. You know, just like let's have impact and let it put me out, or it's just gonna be like we're gonna start progressively just falling, and then you're just gonna have to live in the moment of potential death for the next 60 seconds or whatever it is, and that to me is the worst thing in the world.
Yeah. I don't know. I think the only thing that helps me with that is just knowing like the statistics on it and the odds and the percentages. That's what gets me through it mentally. It's like, I should be more nervous to drive, but
Yeah.
but I'm not scared to be there.
Fair. So, what's to come up next with Fund, and where can people find you?
Well, all the social medias, easiest place to find me. There's only one me in the world with a last name like Freistadt, so it's Justin. Last name's Freischtat. And yeah, we're actively raising money right now. Got a great deal in Knoxville. Want to get that one funded in the next 30 days or so. And then who knows, we'll be on to the next one. But the debt fund's always, it's continuous. So if you ever want a 16% yield on your cash, let me know.
Cool. Awesome. Thanks, man. Thanks for the time.
Yeah, appreciate you having me on.
Of course. Cheers. Love y'all.